Good afternoon, traders and investors. Will back here with another one, coming to you with a Monday market recap. Hopefully you guys had a very nice weekend and a very good day in the markets as well. And in the markets today, guys, well, it's official. We have ended a 9-day win streak on the SPY and the QQQs. Now, the markets weren't down tremendously bad today, but it was indeed a red day after 2 weeks of very nice market action. Now, we didn't have too much in stores of macro news, no major trade deals announced between us and Japan or us and China, but we did have some news on the tariff fronts, which sowed some confusion. This was, of course, the news from the White House that Trump was announcing a 100% tariff on movies produced in foreign lands. Now, the reason I say it brought forth a lot of confusion is because what constitutes a movie produced in a foreign land? We know that sometimes several big blockbusters like to film different sets in different countries. So how much of the movie is actually going to be tariffed? Which is why, after so much confusion, when Trump was asked about this today during a press conference, well, they kind of walked it back. Trump walks back his idea from film tariffs amid mass confusion. So he was saying that he was going to consult with the industry before applying something in a more decisive fashion. That was the only news in terms of that front today. In other news, we had the fear and greed index creeping up from fear all the way through neutral without even stopping there into greed. So is this possibly a criteria for looking to wind down some of those swing trades that we've taken in the past few weeks? Well, maybe, as I've been saying on the channel, right? We know the next narrative in the markets is going to be all about the inventory shortages, the price increases, the layoffs resulting from the tariffs that have now been in place for over 30 days. So it may just be time to re-examine some of our short-term bets that we placed in the last few weeks. And then lastly, of course, the big news today over the course of the weekend, was we had a legend, the man Warren Buffett himself, stepping down as CEO at the end of the year in favor of his new CEO, Greg Abel, taking over at the end of that term. So Warren Buffett has had a very legendary run. We have some Berkshire earnings today. Warren Buffett, 5,500,000% run since establishing Berkshire Hathaway in the 1960s. It's been absolutely historic. And when asked about what does he think about the most recent correction in the markets over the last 30-45 days, well, he told us to possibly grow a pair. Let's have a listen.
What has happened in the last 30, 45 days, 100 days, whatever you want to pick up, whatever this period has been, is really nothing. There's been 3 times since we acquired Berkshire that Berkshire has gone down 50%.
So there you have it, man. I mean, you got to take it from him himself. Apparently, it's really nothing. Just long-term focus, DCA, and find high-quality companies that you want to buy. So in today's video, guys, it's going to be a fun one together. Number one, we're going to be covering 3 earnings that I have prepared for you guys. Of course, number 1 is going to be Berkshire Hathaway. Number 2 is going to be Palantir. And number 3 is going to be HIMS. Now, so many more earnings on the table for this week. Can't wait to bring you perspective on all of them, but those will be the 3 for today. Thereafter, we're going to be taking a look at technical analysis on our major market indexes, do our normal rundown there, and follow it up through our big tech names in terms of looking at big tech and seeing whether or not all of these companies still represent some very decent buying opportunities overall. And lastly, I'll take you through my portfolio for some of the opening trades made for today, and also which trades I am keeping throughout the rest of the week. So without further ado, guys, let's get right into it, shall we? So the SPY down about 0.57, the QQQs down about 0.59%, and all across the board, you can see that the markets were pulling back after 9 days in the green. What does that look like on the heat map? Well, not too bad. We had some pockets of green here and there, but overall, all the major indices were down. Technology down led to the downside by Apple continuing its slide from its earnings last week. Amazon and Tesla also not having a very good time. Berkshire down 5% after their earnings. We'll be looking at that in just a few short moments. And the rest of the banking sector not performing the best. Healthcare as well, getting dragged down over the course of the day. Consumer defensives was somewhat resilient, depending on which names you were looking at. And the bottom half of the market namely led to the downside by oil after some new OPEC regulations came into play. You can see all across the board a lot more weakness than there was strength, of course. A pullback day, one that we haven't seen in quite a while. Now, on the one-day relative, you can see that even better. Only consumer defensives was able to etch out some very, very tiny gains, but the rest of the market to the downside, and energy being the biggest loss leader there. On the 1 week relative, after 9 days of up, we still look pretty good. Only energy in the red, and to the top side, communication services, industrials, technology, and financials were your biggest winners overall. Now, in the 1 month, measuring reporting over the month of April. We knew it was a very volatile month. Big down to start it off with Liberation Day, then a very large rally to cap it all off after the 90-day pause was put into place. Well, we have several big winners. Energy was not one of them, and nor was healthcare, but to the upside, technology, communications services, and industrials were your biggest winners there. So before we get into more technicals, guys, let us dive into our earnings, and we're going to start it off with a big one. Then we're going to get into the fun ones, Palantir and HIMS. But, you know, you got to give the man his flowers. We're going to do Berkshire first. So let's take a look at that, shall we, real quick. So Berkshire coming out with their earnings today. From one point in the morning, they were down top to bottom almost 7%, which represented a phenomenal buying opportunity for people with big accounts to write some short puts, which we did, of course, in my Discord group. But overall, on the day, guys, they were down, but not down because Warren Buffett was stepping down. I would assume that maybe some people had a hard rule set in place to where maybe they've been holding Berkshire for 5, 10, 15, 20 years, and they said, well, when Warren steps down, I'm going to sell my shares. So probably some people had that hard rule, but he's replacing himself with a very able CEO, and that CEO has been chosen since 2018, as a matter of fact. Charlie Munger, fun fact, actually slipped up that Greg Abel was going to replace them in a 2021 shareholder meeting and said that that decision had been made years prior overall, and now it is finally here. But Warren Buffett surprised everybody with that. Even Greg Abel himself did not know Warren Buffett was going to announce that during the shareholder meeting. So let's take a look at some numbers here, shall we? So miss on EPS by about 5.4%. We'll explain what happened there specifically, and a slight little miss on revenue by 1.22% as well, which resulted in the stock having some declines over the course of the morning today. Now, Warren Buffett has definitely gone on a phenomenal rally, beating out the S&P 500 guys by a factor of over 100. And of course, several people commented on him stepping down. Tim Cook obviously posting a very great message and a picture of them together. But here is just the sheer size of Berkshire's outperformance versus the S&P 500 since the 1960s. Absolutely ridiculous performance overall. The S&P 500 returning a measly 39,000%, you know, something small. And then Berkshire Hathaway, 5.5 million %. That was a phenomenal rally and should probably continue in the future because really nothing is changing at the company. Greg Abel, the new CEO, has been, you know, front and center in many of the deals that Berkshire has been doing over the last 20, 25 years. He knows all about the business like the back of his hand, and he was trained by Warren and by Charlie Munger for about that same time period overall since joining the company in the mid-2000s. Now, moving on to the numbers, as a matter of fact, Berkshire Hathaway operating earnings dropped more than expected as Buffett warns of tariff uncertainty. Now, we did comment on the uncertainty. We're going to take a look at that very shortly. The conglomerate, which owns a vast array of insurance, transportation, energy, retail, and other businesses, also warned that tariffs may further hit profits. Now, if you don't know how Berkshire makes its money, guys, it's much more than their investing portfolio. I would argue that their investing portfolio, although a very large component, is not an integral part of the business. There's so many moving parts to this company. Here it is. You have insurance, you have their railroad company, you have their energy division, you have Pilot as well. You have a manufacturing sector, you have McLean, another huge portion of the business right there, and services and retailing, all of that combined, plus many other entities that you don't even see here. Berkshire Hathaway has a massive real estate business as well. All of that combined becomes the conglomerate known as Berkshire Hathaway overall. And this time it was just due to some insurance underwriting stuff. So operating earnings, which includes the conglomerate's fully owned insurance and railroad business, fell 14% overall. Much of that decline was driven by a 48.6% plunge in insurance underwriting profit. Why? Well, Berkshire said the Southern California wildfires led to a $1.1 billion loss in Q1. That is why our operating profit was down a lot more than anticipated. In terms of tariff uncertainty, Berkshire said President Donald Trump's tariffs and other geopolitical risks created an uncertain environment for the conglomerate. The firm said it's not able to predict any potential impact from tariffs at this time. Our periodic operating results may be affected in future periods by impacts of ongoing macroeconomic and geopolitical events, as well as changes in industry or company-specific factors or events. We are currently unable to reliably predict the potential impact on our businesses, whether through changes in product costs, supply chain costs, and efficiency, and customer demand for our products and services. So refusing to comment in terms of guidance in terms of all the different lines of businesses here. Now, Berkshire's cash hoard ballooned to a fresh record during the first quarter, climbing to more than $347 billion from around 334 at the end of 2024, showing that Buffett did not use the first quarter drop in the stock market to deploy the money. In fact, Berkshire was still a net seller of stocks for a 10th quarter in a row. Now, we got some insight when we were listening to the shareholder meeting on the Saturday session from Warren Buffett. What is the cash going to be used for? Is it going to be used to buy stocks? Well, not really. Buffett and his successor, Greg Abel, are looking for deals in energy infrastructure. They want to wholly own something, which has been pretty much his mantra for a very long time right now. The stock market is fun for him. Of course it is. However, they are looking to establish dominance in the energy industry. There was a lot of talk about energy and infrastructure needs of the USA over the next 5, 10, 15 years, and they wanted to deploy a bunch of that capital to energy infrastructure projects that they would build from the ground up to really service a booming and burgeoning portion of the US economy in the next 5, 10, 15 years. So we're going to pay special attention to any projects that Berkshire will do on that front. Now, taking a look at other things as well, in terms of the quarterly revenue per segment, this is the new segment right here. You can see that it's all broken down into different lines of business. For the most part, most of Berkshire's lines of businesses have been very, very, very steady overall. And operating margins, which are this black line right there, have been pretty stable. Now, of course, the California wildfires were unpredictable, and it did lead them to have outsized losses in that division for the quarter. But of course, that is a one-time event. It will not always happen. Moving on further here, guys. One of the benefits of Warren Buffett's stock, for the most part, is the fact that, yes, it is index beating, but it is also not highly correlated. Here we have the correlation index in terms of when the SPY moves 1%, how much does Berkshire actually move? And you can see the correlation coefficient right here in the trailing 3 years has been roughly 0.7, right? This is a trailing 3-year correlation. It goes all the way back to 1986. And you can see that it never really goes above 1. So it is a well-diversified business that when the SPY moves one way, Berkshire doesn't necessarily have to work in the same direction either. And here are your cumulative returns in terms of percentage during market drawdowns. There's been some periods where Berkshire Hathaway has largely outperformed the markets in terms of corrections, such as the early 1980s one, such as the 2008 one, and the Great Financial Crisis, and during COVID periods as well. And even the most recent one of 2022, experiencing far less drawdowns and sometimes even gaining while the market was crashing. But there were two instances, such as in 1987 and 1990, where Berkshire actually did underperform the S&P 500. But overall, the statistics are clear. They tend to outperform in the midst of corrections and recessions versus underperform. And that has been no different this year. Berkshire Hathaway stock over the course of this year is still up 12.32% year to date. That's even before today's slide off the tops. Before this, they were up around 18%. So still outperforming the index in Warren Buffett's last year as CEO of the company. Now, in terms of the fundamentals, is the company a buy? Well, for that, you would have to ask Warren Buffett himself. He's been pretty clear over the fact that he uses price to book, and most people who analyze Berkshire will use price to book. Not price to earnings, not price to sales, not price to free cash flow. They will use price to book because it's a conglomerate, guys. They have so many different lines of business that it's tough to use traditional valuation metrics when you are looking at a conglomerate. The more whole way of viewing it is examining whether the company's assets are at a very decent valuation overall in terms of the price that you're paying for them, because there's so many different assets. And right now, the price to book is at a 1.77. Now, for a long time, Warren Buffett has been very clear that he doesn't really like to buy back even his own stock when the price to book is over 1.2. And as a matter of fact, they have not done any buybacks now for roughly 3 to 4 quarters at this point, deeming the stock to be a little bit too expensive. So if we just use his own words, the stock is expensive right now. However, is the stock a buy? I still do think that Berkshire in any market probably is a buy. Now, you can buy it at a very cheap price, which would be under 1.2, but it's very rare to actually see it there unless the entire market's going into a correction. And as I was showing you, sometimes even when the markets go into big corrections, Berkshire doesn't even drop that much, as we've seen during this correction overall. So I still do believe that Berkshire is a very, very good holding to have in anyone's portfolio. It's not going anywhere. They're a very well-diversified business. And if we had an index portfolio, such as some in the SPY, some in the QQQs, there is an argument to be made to have some in Berkshire as well. I don't personally own it in my own long-term portfolio, but I would not mind owning it at all. Perhaps later on in my life, when I need some more defensively positioned stocks or ETFs, I may be going for a something like a Berkshire when I want to, spread out the delta, so to speak, or to spread out the correlation so that all my assets are not directly tied to the performance of the S&P and the Qs. But I would say for anybody who's in the later stages of their life, this is such a phenomenal company, guys. They've built it from the ground up. Nothing bad to say about this stock at all, other than the fact that it's still trading somewhat rich. And I do not think that Warren Buffett stepping down is going to impact the direction of the company at all. The business model has been very clear. The incoming CEO is pretty much, guys, a direct apprentice to Charlie Munger and Warren Buffett, a very patient individual. You're not going to see him spending a boatload of cash as soon as he is the new CEO. Very patient, and you can read up on him, guys. He has been instrumental in a lot of the energy deals and railroad deals that Berkshire has brokered for the past 20 plus years at this point. So shout out to them. A legend currently is leaving us. You got to give the man his flowers. That's everything for Berkshire earnings. Now, let's dive into another fun one, which is going to be Palantir. So Palantir versus Berkshire. I mean, first you have the old money leaving pretty much, which is Warren Buffett, right? And then you have the new money CEO on the block. Well, he's not that new. This company's been public. Well, not public, but the company's been up and running since the early 2000s. Alex Karp using terms like last quarter talking about his quarterly earnings where Palantir was eviscerating revenue numbers. Curious to see this quarter again, did they eviscerate the numbers and providing a bunch of fun adjectives to describe their rampant growth across the sector? Well, as a matter of fact, guys, they crushed it. Now, although Palantir's price right now is down 9% in the after hours, we'll get into why. It's a bit of, lofty expectations and a hell of a pre-earnings rally overall. But in terms of the quarterly numbers, guys, they absolutely destroyed it, eviscerated it, to take Alex Karp's terms, yeah? On EPS, they did beat by a fraction here, by 1%. Revenue beat by 2.51. But not only did they double beat, guys, they raised nearly every single metric for the year end. It was extremely impressive earnings. So although the stock price is not responding as such, they beat every single number. But this is the NVIDIA effect, right? When you just put up so many good numbers quarter over quarter for so many quarters in a row, people are expecting wild new things every single time. And unfortunately, when you only give them 36% year-over-year revenue growth, well, apparently it's just not enough, right? So Palantir being the victim of its own previous success, but these earnings were not objectively bad at all. They were, as a matter of fact, fantastic. Let's take a look at some of these numbers. Revenue up 39% year-over-year, which was absolutely nuts. Commercial revenue up 71% year-over-year. Operating income, a bright point for the company, really increasing those net margins, 73% year-over-year, and EPS up 63% year-over-year. Fantastic numbers overall. Let's dive into the article. So Palantir lifts full-year guidance as CEO Alex Karp cites a tectonic shift in AI adoption. So last quarter, it was eviscerating. This time, it's a tectonic shift. And I would have to agree, these numbers are very, very, very impressive. So Palantir boosted its revenue guidance Monday as the AI software company saw commercial and government revenue boom. In terms of what he said, we are delivering the operating system for the modern enterprise in the era of AI. Commercial revenues were up 71%, which we just saw. Government segment sales jumped 45%. The company is forecasting that U.S. commercial revenues will top $1.178 billion this year. That is phenomenal growth overall for that segment of the business. Karp attributed Palantir's government sector growth to greater U.S. defense sector adoption of its tools. He said the demand for large language models and the software supporting it had turned into a stampede. Alex Karp, always with these fun nouns and adjectives, right? Palantir's revenue grew 39%, which we just saw. Net income rose to about $214 million. This is a phenomenal net income number for Palantir overall, guys. It's been a very nice journey for them. You're talking about a 24.2% net margin. That is a record for the company overall. They've really come a long way from being a non-profitable company a few years ago to now really ramping up that bottom line. And this one, a record quarter, 24.2% on those net margins. The company also hiked its full year revenue outlook to between 3.89 and 3.9 billion. That's up from an estimate of 3.74 to 3.76 billion. Very nice increase on the top line revenue guidance for the end of the year by Palantir. We believe our results are indicative of a revolution sweeping across our business and industry, and I would definitely agree. The company also boosted its adjusted free cash flow outlook for the year to between 1.6 and 1.8 billion. Now, in terms of the shareholder slides, there's not much to see here as we've covered most of it in the article, but you will see that whatever you are looking at here in terms of Palantir numbers, guys, they are really crushing it all across the board. Let me just jump down to some slides right here. Here's your commercial revenue. Here's your commercial customer count, up 65% year over year. US commercial remaining deal value in the pipeline over 127% year over year. Extremely, extremely good overall, guys. Here's your GAAP net income, which we were talking about, one of the bright points of the company. Love to see them bringing more money to the bottom line. And Palantir has always been a company, guys, with high gross margins, but as they scale more revenue, that's where those high gross margins really start to come alive, right? In terms of their gross margins, you can see that they're almost 80%, which is exactly what you want to see for a high-performing software company. And now they're bringing more and more of that to the bottom line, which is what you want to see when a company is able to scale properly. Operating income also up and to the right. That is very good. Rule of 40 also at 83%, very solid. US revenue growth overall, 55% to the upside, right? Commercial, this is just breaking down the US segment, whether it's commercial or government revenue, both massive, massive growth numbers there, guys. Commercial and government as well for the rest of the world, but total revenue growth, 39%. But now Palantir is kind of hitting the law of large numbers, right? How many years in a row will it be able to grow revenue in excess of 30% and EPS in excess of 30%? It's the NVIDIA effect. We've seen this tons of time in previous historical measures by other companies to where, yeah, the exponential growth starts, but then the law of large numbers starts catching up with you, right? You cannot grow at such large revenue clips forever, but I do think for the next 5+ years, Palantir will be able to grow at least both EPS and revenues by a factor of at least 20% overall. All of these slides are fantastic, guys, right? Whether you look at operating margin, operating incomes overall, the commercial customer count, which was up 65% year over year, the amount of deals that they sign as well. You see the total customer count and commercial again, 139 deals closed of at least $1 million, 51 at least were $5 million, and 31 of which were at least $10 million. So Palantir really starting to hammer it home with its product and ending the quarter with $5.4 billion in cash and cash equivalents. Now, that's never really been a problem for Palantir overall. They don't really have that much debt at all, as you can see from their balance sheet. Very low amounts of debt. And now, lucky for us, the cash pile is up to $5.6 billion, and they do bring in a decent amount of free cash flow. I'll remind you, the guidance for that over the course of this year was a target of $1.6 to $1.8 billion. Now, in terms of their expansion, well, their expansion is going very well, but as I said, you have to remember the law of large numbers, expanding EPS very nicely for the next few years and expanding revenue for the next few years as well. But now what everybody wants to know, guys, now that Palantir is off its highs by about 9%, is the company a buy? Now that it's trading roughly around the 110 mark in the after hours, as we can see from this drop, around 112. So let me just put a line right about there. Maybe actually make it straight, yeah? Is Palantir a buy? Well, that all depends. How much do you actually want to pay for their earnings? I am a Palantir shareholder myself. I have a very cheap cost basis, which I built during the bear market sell-off, but don't get it twisted. I did initially buy the company after their IPO stages and then DCA'd down and had to hold that bag for a whole 1.5 years while people laughed at me. And now, well, the times have turned, and now I can be the one that's not going to laugh at people because I'm not going to stoop down to that level, of course, right? But it's been a phenomenal rally, but I'm not going to lie, even as a Palantir shareholder, guys, the company's objectively expensive, right? Now, the company's market cap is $291 billion. There's no doubt in my mind that eventually Palantir can grow into a $500 billion company, $600 billion, $700 billion, because they have such a phenomenal product with such phenomenal results. Palantir's competitive advantage, yes, their software is better than anyone else's, but as well, they do a lot of hand-holding with their boot camps. I think that one of their biggest competitive advantages is when they sign a new customer, they really make sure that the customer can fully utilize their product. Conversely to other companies, where other companies just sell you their software and then say, well, yeah, here's our software, just figure it out, right? No, Palantir actually brings your dev team to their corporation and does a boot camp with you for 30 days and trains your team onto how to best utilize the product for your specific company. That's why they have the best results, some of the best results in the entire game in terms of efficiency gains that they deliver, whether for government enterprise or commercial enterprise alone. So because of the fact that they have such a nice product and a good competitive advantage, I do believe that this company, the total addressable market, is fairly large. However, it's going to take a long time, right? Their demand is through the roof right now in terms of where they stand of their valuation at around 115, okay? They're trading at a forward 2025 NPE ratio of 209. And you may say, yeah, but Will, they're growing EPS at a fantastic clip, which they are. Their EPS growth rate on average for the next 3 years is 29%. But even when I divide this by this to get a PEG ratio, you're trading at 7.21. I'll remind you, anything under 1 is cheap. Between 1 and 2 is okay. Over 2, really have to ask yourself some questions. Now, there's some fantastic companies that trade over 2 pegs that I don't mind buying because the TAM, the total addressable market, is large and their product is so good. One of those such examples can be something like a CrowdStrike. Another such example could be something like a Spotify, where if we take their projected 2028 numbers, they're trading at a 2.2 peg. There's phenomenal companies that trade above a 2 peg that I don't mind buying. But when you come into a 4, 5, 6, 7, that starts to be objectively very expensive. And at 7.21, it is extremely high. Now, you might say, yeah, but we can take price to sales. Sure, we can take price to sales. But if I do that at 115, 2025 forward price to sales, you're looking at a 77.6. That is extreme levels, guys. Extreme for tech starts to be when you trade at a 20 forward price to sales metric, which you've seen companies like NVIDIA do. You've seen companies like AAPL do. That starts to be pushing the bar. At 77.6, guys, that is an extreme number overall. And you may tell me, yeah, but they're growing a lot of revenue in the future. Can't we just take the one in the future? Okay, let's take the one 3 years from now. At 115, price to sales, extrapolated sales by then are going to be about 6.2 billion. Let's say they keep beating their sales number, and let's say they make it 8 billion. It still won't make a difference, guys, right? It still won't make a marginal impact. Your price of sales will still be over 40. So the company, whichever metric you analyze by, is extremely expensive right now. However, if you are of the view that you want to hold it for the next 5-10 years and want to see how high their market cap can actually go, because you think it's going to be a 500, 600, $700 billion company, well, maybe indeed there is a 2+X left in the stock, but you cannot say that you're getting a good deal on Palantir down here. Now, down here, the valuation they were just at was a much more manageable position. And you might remember me during this corrective phase that I was saying, if you guys were anticipating buying Palantir, now might be a good time to nibble in the low 80s to high 70s and just embark on a DCA process towards more fair value if they do come down here into the 60 to 50 range. Objectively speaking, guys, and I cover a ton of these stocks, and I'm a Palantir shareholder, the objective fair value, considering the high rate growth profile, the objective fair value is somewhere between $60 to $50, and I'm being very, very fair at that point, okay? But who knows? It might not get there. So the best thing you can do if you want to own Palantir for the future is, if you like the company up here, now this is not financial advice, but if I really liked Palantir and I didn't care about the valuation, I really believed in the company, I want to hold it for 5, 10, 15 years and see how much can they actually expand their total market cap before they eventually grow the revenues and EPS into that market cap. And I'm looking at a terminal market cap value of 5, 6, 7, $800 billion, which is on the table if they keep executing the way that they are. Well, the best thing you can do, guys, is embark on a long-form DCA process where with every paycheck, you buy a little bit of Palantir. Sometimes you're going to buy it, it's going to be up here. If the market goes into a correction, maybe it'll be down here. Other times you buy it, maybe it'll be in there. That is the best way to do it rather than timing a bulk purchase with Palantir or just putting on the blinders and saying, I want Palantir at all costs. I'm going to go all in right here because this stock can only go up, right? We have to use a little bit of logic when analyzing this stock because the valuation is expensive. But congratulations to all the Palantir bulls. It's been a phenomenal rally so far and looking forward to much more gains alongside you guys as well. And with that, now let's move into company number 3, which is going to be another very hot and popular retail stock, which is going to be HIMS. So HIMS coming out with their earnings today after the bell, and after the bell, they were down roughly 3%. Now, keep in mind as well, it says 6 there, but I'm taking from the top of the actual close. From the actual close, they're down roughly 3-4%, nothing more, nothing less than that. Now, keep in mind, HIMS as well has had a phenomenal pre-earnings rally just from the Novo Nordisk news, which we're going to get into, whereby they can now sell their products on HIMS as part of a subscription model, right? From that moment in time after the pullback, we've had a phenomenal rally, guys. 30% in the last just few days, and that is after the NVO news. That day alone was another 30%. If you take it from that news catalyst, or before it rather, you're talking about a 47% rally. So you could say that a lot of these earnings might have just been priced in as well. But how did HIMS do on their quarter? They absolutely crushed it. Got to give them their flowers where flowers are due. They had a very good quarter and did raise the bar for the rest of the year. However, there was a little bit of soft Q2 guidance, but for the end of the year, they did maintain their overall guidance and said they had a lot of bullish partnerships that they were looking to explore, similar to the one that they just signed with Novo Nordisk for their Wegovy weight loss product. Now let's move into their numbers. Beat on EPS by a fat margin here, 65% beat on EPS, and a nice beat on revenue by roughly 9% as well. In terms of the numbers, it looks something like this. Revenue up 111% year over year. Fantastic subscriber growth year over year, 38%. Very good business model, a recurring subscription model for them. Monthly revenue as well per subscriber was up 53% to $84. So not only do they have more people on their platform, but every single person is spending more money on that platform, getting more and more of the services that they offer. And adjusted EBITDA as well, 182% to the upside. This is a measure of profitability. Nice to see such a very, very large increase in relation to last year's. And here's your adjusted EBITDA margins going up and to the right as HIMS also, similar to Palantir, scales into its profitability curve. Let's move into the article. So HIMS and Hers gives weak outlook. Not so weak, but says more collaborations are coming, which is very bullish for the company. You saw what happened after they had that partnership with NVO. They soared 20% plus after Novo Nordisk said it would offer its weight loss drug Wegovy through telehealth providers like HIMS and Hers. $500 a month subscription cost for that one. Now, shares of HIMS and Hers fell in extended trading on Monday after the company reported first quarter earnings that beat the expectations, but offered weaker than expected guidance. It wasn't so weak. There's a bit of a, you got to take it with a grain of salt, right? So HIMS and Hers reported a net income of $49.5 million. That was very good, guys, overall. In terms of net margins, you're talking about a cool 8.4%. Now, I'll remind you that HIMS and Hers was not always a profitable company. Matter of fact, it spent 2020 through 2023 in the red in terms of net margins. But over the past year and a half, they've been steadily increasing net margins, and this quarter was no different, having one of their better quarters of all time, 8.4% net. Let's continue, shall we? For its second quarter, HIMS and Hers said it expected to report revenue between $530 to $550 million. That was the soft guidance in relation to the 564 expected by the street. On April 29th, the shares rocketed up 20% after they partnered with NVO, which we already read above. That should be a very good growth factor for them. Over time, we expect wider collaboration across the industry, such as that deal that they just signed with NVO, inclusive of pharmaceutical players, innovative leaders in diagnostic and preventative testing, and world-class providers, said the CEO. We believe this will strengthen our ecosystem and position us to curate a best-in-class offering that can reach tens of millions of people, and I truly do believe it as well. Earlier on Monday, HIMS and Hers announced that Nader Kabani will join the company as its chief operations officer. Kabani spent nearly 20 years at Amazon, where he oversaw the launch of Amazon Pharmacy, the company's acquisition of PillPack, and its global COVID-19 vaccination task force. A veteran of the game in a similar role prior, now will be bringing his expertise to HIMS and Hers. Love to see stuff like that. Now let's move through some of their earnings slides. They provided us some guidance for both end of the year and for 2030. By 2030, we have revenue of at least $6.5 billion. And when we go into the valuation, I will also extrapolate out there to tell you guys if that's the case and they trade still at current multiples, what could their share price be by 2030? And by 2030, an adjusted EBITDA of at least 1.3, which is pretty good, guys. Talking about 20%, right? Roughly 20% EBITDA margins overall, which is fantastic overall for the company. Now, in terms of the rest, share of total subscribers and those of them utilizing a personalized solution. So here we go. Nice boost in terms of total subscriber rate here, and personalized. This is really good, guys. More and more people are choosing to have a personalized subscription model with HIMS, which is very good. What does that do, guys? It goes to customer loyalty and customer retention. The brand is building a relationship with every single one of its clients individually. That is what you want to see when you have a subscription model for a company such as this, right? Now, they're also increasing their position in sexual health, which allows them to evolve with their customers as their needs change. As we can see, they did the ED, heart and health, launched in 2023, the hair health as well in 2024, but now the new ones, testosterone support in March of 2025, and the RX Plus multivitamin for sexual health as well. So constantly coming out with new products. And you know that when you have people in the ecosystem, a lot of people will take those new products overall. Now here's the new partnership with Wegovy overall. This is a injected form of course of the GLP-1 weight loss drugs. They also do oral weight loss. That's their own products too. And overall, very, very good. They offer several plans, activity plans, nutrition plans, provider care as well. Goes into a whole weight loss offering rather than just giving somebody some drugs and say, there you go, have fun with it. You know what I mean? So this is what really keeps a sticky client within the ecosystem overall. Love to see it in terms of that. Now, in terms of revenue, you can see their numbers right here. They did offer some guidance overall for the end of fiscal year 2025, 56 to 63% growth in terms of revenue overall for the end of the year, which is very good. Underlying themes, 85+% long-term retention of their customer base. That is exactly what you want to see. And nice EBITDA margins right here. Overall, of roughly 13 to 14% in terms of EBITDA margins. A nice little step up from Q2. So they will be performing a bit better at the bottom end of the range coming into the rest of the year overall. So looking very good in terms of HIMS and hers, guys. There's really just a few more slides that I did want to show you overall, such as the ones down below, which is going to be the financials, subscriber and revenue growth. As you can see, single day, 30-day subscribers, guys, all the way down here, right? Now we're getting much more multi 30-day subscribers. So really a recurring sticky business model overall. And the revenue just prints up and to the right with the monthly average revenue per user going up and to the right. As people stay within their ecosystem, they're obviously getting more and more profits from the company overall. So very nice report by HIMS and hers. Now, the soft guidance is the one thing that was kind of a little bit of a dwindling effect on the stock price in the after hours, and the fact that they've also had a tremendous pre-earnings rally. So you can argue that maybe some of this bullishness was priced in. Now, all that considered, is HIMS and hers a good buy right here? Well, after patiently waiting myself for this company to come down off of its massive hype rally and establish a new price base of support, I was actually able to pick up the company just before this meteoric rise to the upside. So I am in myself. I only got 70 shares, guys. A very small position for me, a starter position. I was looking to wait into earnings to see if the company could be in or around that price for a bit longer, but now it's actually lifted off. You can see my average price is just under $28 overall. I know a lot of you have a much better entry price, but I am now in this one as well. Would I buy more here at $42? Well, it depends on the time horizon. When I buy something, I usually buy it for the next 5 to 10 years. And HIMS does have some very good long-term growth prospects for the company. Revenue and EPS are growing at very nice clips through 2027. The company does not have any problems with debt. As we can see from their balance sheet, they hold a ton of cash on the balance sheet and do generate some pretty good free cash flow over time. So debt is not a problem. And we do know that in terms of EPS and revenue expansion, it should be a steady expansion as they gain more and more subscribers and more revenue and seek to establish more and more partnerships, as they were describing in their earnings call. At $40 right now, the valuation stands at a 61.54 forward price to earnings. Now, they are growing EPS at 17% per year, which gives them a PEG ratio of 3.62, which is high. Not as high as Palantir's, but it is quite high. However, when earnings are so small, traditionally what you can use is something like a price to sales metric, where you measure the company's market cap against its total sales. And since this one is a recurring subscription model, it is somewhat of a technology company in the way that it operates its subscription model and its technology platform in terms of marketing and stuff like that. So you could technically give it a forward price to sales of all the way up to a 10. A 10 is like pushing it for this style of company. At 4, it does leave some room for expansion. So if we were to take in consideration, guys, their 2030 guidance, if we have a 5+ year time horizon for investing, and they gave us the guidance in terms of revenue, $6.5 billion. If we maintain the top end of the range, either at 5 price to sales or close, to all the way to a 10 times price to sales, that gives them a forward market cap of $30 to $65 billion overall. That is the price to sales range that you could be exploring HIMS at at that time in the future. The company right now is trading for about $9.37 billion. At the bottom end of the range, you'd be looking at a 3x. At the top end of the range, you'd be looking at roughly a 6x. So if you have a long-term time horizon and you want to see them go into that 2030 time horizon, right, then that is probably a decent buy for HIMS overall. That's a compound annual growth rate in the double digits, close to about 15% per year. Overall, if we look at the next 5 years and expanding into the lower end of a 5 price to sales, provided that they still execute properly overall. Just always remember, guys, that HIMS is a marketing company over and above everything else, right? None of the things that they sell on their platform are really proprietary technology to them. They're not really developing new drugs. They're in the business of taking existing drugs, bundling them together in a subscription package, and giving you a personalized service. There's nothing wrong with that business model, but just understand that is the business model, right? You can argue that they're somewhat more of a marketing company than they are actually a innovative health company overall. They're innovative in the way that they're doing their business model, but they're not innovating actual drugs, right? So you got to kind of separate the two. And when that is the case, the one thing, because when we do an analysis, you have to do strength, weaknesses, opportunities, and threats, right? So the weaknesses and the threats are the facts that right now, well, you can find competing products on Amazon just for hair loss solutions. None of these are new, right? Minoxidil, finasteride, none of those are new. And Amazon is selling some of those on their platform for also a recurring monthly subscription for $16 per month, whereas HIMS is selling them for $22 a month. But obviously HIMS has a better package solution, an individualized solution for people and much more resources than Amazon. But HIMS cannot compete on price alone. That is the weakness, and the threat to this business is having to compete with other very large providers such as the likes of Amazon. So when you have an investment thesis, we cannot only look at the upsides, we have to understand what are the threats to the business and the weaknesses. All that being said, I do believe there is some very nice upside on HIMS, and any dips can provide some even better ROI opportunities if we are looking for a long-term investment. And that is everything for my earnings analysis across those 3 fantastic companies. Now let's move into some charts. So when we take a look at the SPY, we can see that several indicators now, guys, are starting to flash a little bit of a warning side in terms of a sell signal. Number 1, of course, has to be the fear and greed index now oscillating into the greed. And number 2 has to be the percentage of stocks indicators that I bring you guys through a number of times per week. The first one is percentage of stocks above their 20-day moving average. You can see we are clipping into the top end of a very long-standing chart. This one goes back to 2002. So you can see the short-term momentum on the markets has been nothing but up and maybe due for a little bit of a pullback even after the last 9 days worth of rally. Percentage of stocks above their 50-day EMA only at 48% of all stocks above their 50. So that one is still flat, but you can correct to the short term to the downside here, but still remain above your 50-day EMAs, right? These will be curling to the upside, and percentage of stocks above their 200-day moving average is still at the lower end of this long-standing chart at about 34% of all stocks. It just goes to show how much damage was actually done during the correction. Some of your short-term moving averages are pointing to the upside, and you can see that even on the SPY, right? To where the SPY itself has recaptured the 20 EMA, right, which is around, I don't have it on the chart, the 20, this is the 26, right, the orange line right here. So it's widely captured the 20, much easier. It's recaptured the 50 EMA and now just barely above the 200, but not many stocks have recaptured their own 200s. So that's what it looks like, right? You also have to understand that short-term timeframes are going to be essential for our analysis right here. We are just barely closing above the support box. Now, I closed it green already because it was a clear close above, but we're rejecting from some weekly moving averages here. If we cannot fully mount above this box and start curling lower, you're going to see it on the short-term timeframes first, and it all starts with a loss of the 4-hour trend. We have not lost the 4-hour uptrend this entire second stage of this rally. You had one move there, but we got no follow through. This would be a categorical downtrend, right? Lower highs and lower lows, downtrend. That is how you will know that your daily consolidation phase is underway. When that is underway, you're looking for anything above 541 on the SPY, looking for a daily higher low for possible some trend continuation. A couple gaps remaining to be filled below us right there, but the bulls do have a decent amount of space. In the event we roll this over because the rest of the week is bad and we run into Jerome Powell, which kind of throws some cold water on the markets on the Wednesday session, or we get some negative developments in terms of trade deals, well, that is definitely going to send the markets a little bit lower, and you could be looking for a weekly higher low. Just keep in mind who's in control of these weeklies here. Weekly uptrend is nice. Any move lower looking for a higher low, anything above 508 we'll be looking for a higher low for possible further trend continuation or a second attempt at breaching this resistance and support area at the same time in a more convincing fashion and working towards the 585 to 575 area, which is just above us right now. In terms of the Qs down about 0.59 today. Same analysis, right? Beautiful daily uptrend right now, but starting to show the first signs of curling over. Pay special attention to the lows of today's session. If we drop through there, looking for a 4-hour downtrend to be established, and that will be the loss of the daily move. We're looking for a higher low. Anything at this point above 462, the bottom end of this candle right there. Higher low into support, which right now is 480 down to 465. Higher low for maybe continued trend expansion into the higher end of resistance 510 to 495. To the downside, if we do lose the uptrend overall and do something like that, you're looking for a weekly consolidation period, weekly uptrend, any move lower looking for a higher low, anything above 427 looking for a higher low, maybe to continue the uptrend when we're through a little bit more stages of volatility. Now, moving into financials. Financials also down about 0.64% today. Not the worst day for financials, but definitely trying to fill the gap that we left behind. Same analysis. Daily uptrend is clear as day right now. Looking for a higher low. All the moving averages are below us, and we have a nice area of support too, 48.34 to 46.72. That's all of that region right there, culminating in the 200-day EMA, which is well below us right now. Anything above 47.50, looking for a higher low, possibly a good old breakout, retest, and maybe run into clip this higher end of resistance, 51.35 to around 50, which is close to the all-time high areas overall. In terms of the bull control on the longer-term timeframes, it is a clear weekly uptrend. The weekly MACDs are also pointing in the right direction, and any move lower would just be looking for a weekly higher low, anything above 45.12. Weekly higher low for possible further trend continuation as well. As long as the bulls control the daily and the weekly timeframes, the bias is still up, but we know not to be getting too greedy in these markets because we are about to approach the period in time where the macro data from the tariffs starts eroding, right? We know I covered this on the top 5 options video yesterday, but I also covered it at the end of last week. The last chips from China are coming into port over the next week or two, and you may start seeing some layoffs in transportation and logistics, and you may start seeing a little bit of panic as you might see emptier shelves than normal, and the media is definitely going to run with that narrative. If I was looking for a volatility catalyst here in the next 2-3 weeks, that is definitely going to be it. Moving on to XLV healthcare right now. So healthcare just doing still a whole lot of nothing. The higher lows are set right now, 136.53. Break it to the downside, you have a new daily downtrend. And overall, it's a nice weekly uptrend, but they didn't really get that much lift. Not as much as the other indexes, mind you. Any consolidation looking for more higher lows, anything above 132 for a higher low for maybe some trend continuation to here. But I mean, the clearest time frame here is the monthly, guys. We're just literally backtesting even the 3-month chart, right? This is like a 2-year range of consolidation. This is a quarterly chart, yeah? We're just backtesting a massive level. It's going to be a big struggle for the bears to get through this one. And I think this is going to be the final resting place for healthcare. Probably even if the markets go into a more larger consolidation phase, I don't really think healthcare is going to have the chance to really break down below 126. So I'll still be shopping for my favorite healthcare companies when I can find them on big red days. And lastly, into semiconductors right now, 0.65% to the downside, moving a little bit lower today as they struggle with resistance. 232 down to 214 is that resistance range. Daily uptrend is nice. Looking for a higher low, anything above 204, looking for that higher low, maybe to continue making some price action improvements into resistance. However, take back too much and convert to the downtrend, well, unfortunately, you'll be into weekly consolidation right away. Good thing the bulls have a lot of space, though. Anything above 184, looking for a weekly higher low for maybe a second or maybe third, if you include that one, attempt at breaching through this resistance range. Still a big fan of playing semiconductors, but playing them carefully. Any big red days on my favorite semi plays will be met with some short put action under the market, trying to target as close as possible to my fear lows. Talking about AMD, NVIDIA, Micron, ASML, and a few others that I keep a close watch on, that I give you guys updates on every single day, almost of the week. Onto the IWM now. 0.77% to the downside following the rest of the markets. The Russell has had a very nice rally overall, very nice uptrend, but not quite clearing the upper end of our resistance range, which is why this box still remains red. 200 down to 190 is that very, very deep area of resistance, which has proved to be challenging for the bulls and bears to get through, depending who's above or below it, right? That being said, looking for a higher low, anything above 190.5, looking for a higher low, maybe for further trend continuation, but lose it over the next few days with a bearish market narrative from inventory shortages and price hikes and stuff like that, well, you might go into weekly consolidation, and that's going to look something like this. Weekly uptrend can be eroded, and looking for a weekly higher low, anything above 181, looking for a higher low, maybe for further trend continuation. We will see who is going to be in control of the charts at that time. But right now, the analysis is clear. The weekly bulls are in control of this move, and the daily bulls are also in control. Until that time changes, the setups would technically be looking for longs, but I would also be looking to hedge and or just shore up some cash, especially if I'm day trading, to maybe wait for some better deals as the market potentially embarks into its next consolidation phase. Moving into the Dow Jones right now, Dow Jones, relatively the same analysis, nice daily uptrend right there, looking for a higher low on any drop, anything above 39,750, looking for a higher low, maybe to try and bounce above this area of resistance, 41.3 down to 40,500 is the big line of defense right now for the bears, and they're still playing good defense. Not above the 200-day EMA on the Dow Jones just yet. The weekly, though, is clear as day. Beautiful new weekly uptrend, and if you erode this daily into a downtrend, you'd be looking for a weekly leg of consolidation, and at that point, anything above 37.8, looking for a weekly higher low for maybe further trend attempts later on in the month of May or June after the consolidation phase is done, if that is the direction the markets want to go. Tons of support areas below us on most of all these major indexes. So things are not looking too bad overall. Taking a look at the VIX was actually up today by about 4.32%. Not moving too much, but I've been saying this for a while now, guys. In this market environment, which is such a headline-driven market, if you start getting more news about the shipping containers, about the inventory levels, about the price increases, about the layoffs, what do you think is going to happen? Well, the VIX, of course, is going to go right back up here into the 30 range. In prior markets when economic times have been uncertain, such as 2022 or COVID or 2018 tariffs, episode number 1, or the flash crash or the great financial crisis, you've been able to see elevated VIXs for more extended periods of time than people are comfortable with. So keep that in mind. I would not be surprised if the VIX stays somewhat sticky between 20 and 35 for the next coming weeks as we start to price in the damage all across the board that the tariffs have done so far or will maybe be causing in the future if they are maintained. Now, moving on further, the dollar. So looking at the dollar, guys, the dollar is still somewhat weak, right? We have a very nice rally in equities, but the dollar is not moving up. So you would expect that if foreign buyers were behind this equity rally, and well, the bonds, not really, because the bonds haven't done anything, but if foreign buyers were behind the equities rally, you would have got a much higher push in the dollar. So far, we're not seeing it, which has led some analysts to believe that maybe this has just been a short squeeze, or maybe this has just been domestic money plowing back into the markets with a little bit of FOMO, a little bit of thought of them being late. Overall, though, guys, clear break of structure on the dollar here, 103 down about 100.5 is that big resistance range above us. Are we going to do something like this? We don't know, but one thing's for sure, if we get another fear-driven narrative from the inventories and all that, let's just say the macro erosion as a result of the tariffs, I would not be surprised to see the dollar start plunging a little bit more as well. We'll keep a close eye on it, but it is bouncing out of oversold conditions. Bonds as well, guys, up 0.95% overall. So the bonds has been a very, very tricky trade. The only thing we know for sure is around 4.5 on the 10 and around 5% on the 20-year yields. There is some sort of a Fed and Trump put at the same time there, to where every time that happens, the Fed starts talking nice to us, saying that they have several tools to step in if the jobs market were to unwind. Talking, of course, about rate cuts and quantitative easing, buying bonds on the open market essentially via the Treasury. And also Trump starts talking very nicely about the whole tariff situation and starts announcing the premise of several other deals. So if we approach that soon, will we get more relief from the administration and from the Fed? We'll have to monitor that closely. But all in all, TLT 20-year bonds have just been stuck down here. I still think it's a good trade because we know there are puts in play by the Trump admin and by the Fed as well. It's a good play, but you have to have a very long-term time horizon, and just don't be disappointed if it doesn't start moving in our direction right away. Lastly, we're going to cover gold here briefly. So gold had a phenomenal rally today. That was up almost 3% on the Monday session, guys. Fantastic rally in gold. We were monitoring this daily downtrend and looking to see, well, maybe that is just a weekly phase of consolidation, which it was. I was personally anticipating a pullback to the 12 at the worst point for gold, but it did not quite get there. But don't blame me for wanting that, right? Oftentimes it does pull out in the 12, and waiting for that moment can provide the juiciest trade opportunity. As of right now, the bulls played some good defense, and now we are stuck, right? We're still not in daily uptrend. This is a nice engulfing move need to set a new higher low and embark on the new daily uptrend, but gold is still looking very solid, and I would not be surprised if it remains a favored asset over the course of the year, as we continuously are in the atmosphere of uncertainty, and gold is an asset that does very well when there's a lot of uncertainty around the dollar, around yields, around equities. Very nice for a barbell strategy for a portfolio. And now Bitcoin it was a little bit down today, but overall, over the weekend, guys, we did have a few down days on Bitcoin, but I wouldn't say we really lost some levels, right? Higher lows are still planted right now at about 93,000. If you lose those or set a higher low, or excuse me, lower high into lower low, well, they're going to be looking at a daily downtrend, right? And you're just going to be looking for a weekly leg of consolidation. Good thing for us, below us is support 92.2. Let's call it about 93K, guys. Down to roughly 87,000. So like 92, 93 down to 87. A very clear area of support below us for the bulls. Weekly uptrend is very nice. You'd just be looking for a higher low. Anything above 74K, looking for a higher low, maybe for some trend continuation. And the weekly bulls do appear to want to play ball as seen by that weekly momentum curling to the upside. So a bit of consolidation never hurt anyone, but Bitcoin has been holding up very well indeed. So we're going to have to wait for that price action. If Bitcoin pulls down here hard, I might be looking for that type of play, going for the good old breakout, retest, and possibly run up to the higher level, which is going to be 105, down to roughly 100,000 flat in terms of psychological resistance. All right, now lastly, taking a look at our big tech names, shall we? So moving into Apple, Apple down another 3.15%. The earnings slide continues on Apple. We covered their earnings last week, so make sure to check that out. End of the day, though, Apple is still Apple. They're doing a ton of buybacks, but they are struggling in a few key segments. Their iPhone sales remain weak, and the sales pipeline for the company still remains weak overall, just not growing revenue at the same clip that they were a few short years ago. So you have to compensate for that when looking at the valuation right now, which is a little bit high for the amount of growth the company has in play. That being said, the bulls right now are still in control, barely, but anything above 189.44, looking for a daily higher low, maybe for some trend continuation, but clear rejection from resistance right now after earnings. 220 down to 210 is that level of resistance. Below us, some nice support, 196 to 187 overall. The weekly bulls are looking to play some defense as well. We almost had a weekly uptrend. They couldn't get the close, guys. So right now, no new weekly uptrend. This is a double top. So right now, maybe just some extended consolidation between support, between resistance. We will see. One thing's for sure, if Apple keeps dropping into this range, I'm a big fan of playing short puts below the fear lows and below that support line overall. And it could be a criteria for a swing trade, guys. If you pull down into this region hard, right, and then find a new daily uptrend, when you get the break on the daily uptrend, the entry goes there, the stop loss goes below the weekly lows, and then you're targeting the top end of the range. So I'll keep you posted if I see any swing trades on Apple, but as of now, short puts is my favorite way to play this one. On to AMD right now. Well, AMD has earnings tomorrow, guys, and it's a bit tough to gauge where AMD is going to go. I think that their earnings cycle is going to be fairly good, but, you know, we've seen several times so far in this market to where even when a company has good earnings, the stock might go down, right? So in terms of AMD, earnings tomorrow after the close, take a look at their expected move. Their expected move for tomorrow overall is about 7.5% either way. So 7.5% for AMD to the upside would mean that they would put them right about 110, not quite clearing our resistance zone, which is 112, 297, and 7% to the downside would send us right down to the daily higher lows, which are planted right now at about 92. So curious to see what they have to say in store for earnings. One thing's for sure, though, the daily uptrend is nice. Lose these lows, though, and you lose the daily uptrend, and you open the door for the downtrend and into just more weekly consolidation. Something like Apple, right, where they haven't really got that much lift on the weekly uptrend, rejecting from the 12 EMA, but they have earnings, right? If earnings is good, then you'll have some nice lift, and then we can evaluate for some swing trades. But if they come down, I still think it's a great opportunity to be writing some short puts under the market. I will update the fundamentals of this stock tomorrow because we have earnings tomorrow, but it's suffice to say right now, they are trading in a very cheap valuation overall in around the $100 mark. I will love to play some short puts down below there in the 85 to 90 range. Onto Amazon right now. Down about 2%. They also keep sliding from their earnings results that we covered on the channel last week, so make sure you guys Check them out if you haven't already in last week's video. And Amazon as well, still struggling a little bit. We know the bulls have the daily uptrend. They've now come down a little bit, still seeking for that higher low, anything above 178.50, looking for a higher low, maybe for some trend continuation. We will see if they can get it. They have not been able to clear this 191 down to 180 level of resistance. It's proving to be a bit challenging for them. All the weekly moving averages are above there. And although it does look like the sign of a weekly uptrend breakout, we have some form of a double top right there, just like Apple. Good thing for the bulls though, even if we unwind this uptrend and go into a daily downtrend, got a lot of space on the weeklies, right? Anything above 165, looking for a higher low, maybe for a second or maybe third attempt at trying to blast through this resistance range. I'm still a big fan of buying Amazon down here, especially in the lower 170s. So as a result, I will continuously play short puts in the bottom end of that range. They had phenomenal earnings overall, and the valuation right now at 185 is quite manageable, even for entries for long-term portfolios. If you wanted to enter here at DCA over time, if the stock moves lower, I think it's a very juicy proposition, especially if we come back down there into the 170s, which is the highs of 2021. On to Google right now. Google up about 0.14% overall. Not the worst day for Google, but also struggling to best its highs of the post-earnings session. Google is still trying to go into a new daily uptrend, but struggling with the double and triple tops right there, not getting it done. In the event we lose 157.41, that would be a daily downtrend and getting rejected from resistance, guys. 175 down to about 163 is that very hotly contested resistance range. That being said, we are in a weekly uptrend right now. Any move lower would be looking for a higher low, anything above 148. Higher low, maybe for some trend continuation. I'll be looking down here if we do pull back down there to write some short puts into the fear lows if I can. That would be 150 down to 136. 2021 highs overall, and Google had fantastic earnings, but just not getting the lift that some people would have hoped for. But under 170, the valuation still does remain one of the cheapest in all of big tech. Moving on to Meta right now. Meta up 0.38% today. They actually got some lift after earnings because their earnings were quite good. Covered those on the channel just last week as well. Daily uptrend, clear as day. Almost breaching the resistance range. 600 psychological, guys. Not closing above it just yet. You can see it's been a clear area of congestion for the bulls and the bears, which makes it a very big level of interest overall. That being said, if we do drop from here, looking for a higher low, anything above 530, looking for a daily higher low, maybe for some further trend continuation whenever this move stops, right? Looking for a higher low with a lot of space. On the weekly timeframes, you can see a clear weekly uptrend break. So even if you lose this and go into a daily downtrend, you know you're working with a lot of space. Anything above 480, looking for a higher low. For further trend continuation, those of you with bigger accounts may want to explore a possibility of playing a meta short puts. If you get a consecutive drop here into the mid to low 500s, short put opportunities down there into the wider range of support would be a nice trade for Meta that I will be doing myself as well with my big account around 575. The valuation is still very low, even around 600, guys. The valuation on a forward basis is quite manageable for Meta. On to Microsoft right now. Microsoft continuing its green streak after its own earnings, up another 0.2% today. Daily uptrend is clear as day as well. Anything right now above this guy right here, 384, looking for a higher low. For possible trend continuation, we will see, can they uphold this resistance range that they broke through, 433 down to 425? Maybe they can hold it, but if the whole market consolidates, guys, you know, Microsoft is probably going to start breaching down below, establish some more support, and then maybe go for it with a bit more momentum to the upside. So keep that in mind. Any daily downtrend or extended consolidation phase would be looking at this point for a weekly higher low. At this point, a lot of space, guys. Anything above 355. Looking for a weekly higher low for further trend continuation. And if I ever see Microsoft again down there, 410 down to 390, juicy area to be writing some short puts, or maybe for some swing trade longs as well from the bottom end of that region if the SPY and the QQQ go into a bit of a corrective phase. On to Netflix right now. So Netflix not responding well to that 100% tariff on foreign films, but throughout the day, as Trump made his comments more clear that he was going to discuss with the industry before implementing those series of tariffs, well, Netflix was able to recover, but here we see a clear loss of several short-term moving averages, which the bulls were supporting the entire portion of this rally. If you get the lower high into lower low, essentially, the 4-hour uptrend is lost, which is looking like that right now. And you may be into a bit of a consolidation phase after such a beautiful rally by Netflix, guys. Anything above 895, looking for a daily higher low, maybe for some trend continuation, maybe. Pull back too much, you open up the door for a daily downtrend, and at that point, you'd just be looking for a very much needed consolidation phase on Netflix, looking for a weekly higher low for possible further weekly trend continuation when that weekly consolidation resolves itself. Where could you be looking for maybe? Well, prior all-time highs, 1,050, $1,000, and that maybe might be in line with the 12 EMA, which is also curling up into that section right there. That would be the first line of defense for the bulls, in my opinion, because they haven't really set much of a support level at all in the last 5, 6, 7, 8 daily candles. Onto NVIDIA right now. NVIDIA down about 0.59%. Also struggling to breach above this big resistance range, guys. 115 down to 105 is proving to be somewhat problematic for NVIDIA. It's been problematic before, and it remains as such. Who is in control, though? Daily bulls are in control, looking for a higher low, anything above 104, looking for a higher low for possible further trend continuation. Nice to see it's still above the short-term moving averages, and that they seem to be curling as well. On the weekly timeframes, though, you can see double top, no confirmed weekly uptrend just yet. You would need to see NVIDIA break above 115 and close there by the end of this week to actually confirm a weekly uptrend. If we move into more consolidation, you might be looking at a tightening range between two levels. That is between our support range, our resistance range rather, and support below 96 down to 78. If I see a big drop on NVIDIA, I would not hesitate to write some short put options, trying to target the mid 90s to mid 80s range, the bottom end of all of these guys down there. But overall, the valuation on NVIDIA right now remains quite manageable, as we can see from right here, a 22 forward price to earnings at $100 and in or around a 1 peg for the moment. Moving on to Tesla. So Tesla down 2.42% as Tesla as well can just not seem to breach the highs of the most recent few days of trading. The green line right here is the 200-day EMA as well, so please keep that in mind. Resistance stays planted here from 303 down to 257, but it's nice to see they're at a tight range here where at the top end of a move, as long as they don't lose this low right here, 271, they can have a shot for this being a bull flag and going on for a further rally. Breach that though, and you set up a daily downtrend, and you're just going to be into a weekly consolidation phase for Tesla, looking for higher lows above 224. That being said, no weekly uptrend. Equal highs, very wide range of accumulation for the bulls. If you move to the downside, of course, your big support range down below there is 220 down to roughly $200. So no trade for me on Tesla just yet. When it's in a range like this, I like to play it one of two ways. Either play it at the bottom of the range, or give me a breakout of a resistance level, a retest as support, and then you might find some entry criteria. But taking it right here, just pretty much guessing or banking on this bull flag pulling through, it's a bit of a risky one as long as we do not close above that 300 psychological area of resistance. On to Palantir right now. Palantir down 0.41% on the day. And of course, as we saw, an extra roughly 9% in the after hours. So Palantir now will, of course, be sacrificing a lot of this 4-hour uptrend that we just had, most likely going into a bit of a consolidation phase. We'll see, though. Palantir bulls can be quite aggressive, and you can see a little bit of buying pressure early in the markets tomorrow. But if we do embark on a daily consolidation phase, the bulls have a lot of space, guys. Anything above 89 right now, looking for a daily higher low, maybe for a new all-time high attempt. Give back too much, though, or roll over into a daily downtrend, and you'll be into a weekly consolidation phase. Palantir has rallied tremendously off these lows, guys, from $66 to where they stood before earnings. That was a 90% rally, almost a 2x from the lows that we experienced in the month of April. This is 1 month, guys. 1 month, almost up a 2x. Fantastic move, identical almost to the one that we saw just back there. So you would be looking for a weekly higher low at this point, anything above 89. Still looking for that weekly higher low for maybe a second attempt or maybe some extended consolidation as Palantir grows into its newfound valuation. Phenomenal stock if you ask me where I want to trade it. Big drops open up some nice short put plays, possibly in the mid to low $80 range because of all of that volatility. On to SOFI now. SOFI up 1.26%, but still not doing a whole lot, right? We know that SOFI was in a nice daily uptrend. They had their earnings, came down, and now it's up to the bulls to prove it to us. Can they protect this lower end? 1215, lose it to the downside, that's a daily downtrend and will also be synonymous with weekly consolidation. Good thing the bulls are in control though now. Downtrend, now we have it replaced with a nice new weekly uptrend, looking for a weekly higher low, anything above 1050, looking for a higher low for possible further trend continuation, right? We know where the support range is. It's below us, 1170, down to roughly $9. Top end of that is roughly 12, 1150-ish. So I would be looking to make some plays on SOFI. If we dip down into here, I'll be writing some short puts at the bottom end of this range, looking to acquire a few more shares. Very bullish on this company overall. It's just that now we're somewhere in between, right? Halfway between support and halfway into resistance as well. So no clear swing trades from me just yet on SOFI. It doesn't look terrible, but my favorite way of playing this one, of course, is either long-term shares or just writing short puts under the market at a more decent level of support overall. The valuation still does remain quite manageable for SOFI at the lower 12s. Into Uber right now. Uber, almost brand new all-time highs. This is the new Palantir or something like that? Not quite, but it's been on a phenomenal rally. Daily uptrend is clear as day right now. Higher lows are now set at these lows right here, 77.14. I can gladly close this resistance zone into a nice green box of support. And now we have one trade opportunity that may be quite noteworthy for us. Any pullback lower, we'll be looking for a higher low for possible further trend continuation. So if we're looking for that on the weekly time frame, what is that? Weekly downtrend into a big breakout like this. This is the good old breakout, retest, and maybe run. They tried to get it done there, couldn't quite do it, but now this is a clear mount and break above. So any retest plus the DMAs are going to be right there. If I can see an entry point here, 80 to about $76, there might be a criteria for a swing trade with a stop loss and going back up to those all-time highs. One of my favorite trade setups overall. So watch for it. We get to hear from Uber earnings this Wednesday before the open. So not that much, but if we do come down here after earnings, I'll be a big fan of possibly playing some Uber trades at that point in time. And now lastly, TSM. TSM down 1.61% today. Semi's not having a good day overall, especially with what happened with the Taiwan dollar today. Didn't talk about it quite much, but if things persist, I'll maybe cover it in a future video. That being said, nice daily uptrend on the way for TSM right now. Couldn't quite make it up to the resistance range, 193 down to 183 roughly. Anything right now above 160, just looking for a higher low for possible further trend continuation. I forgot to close this box green. My bad. I will graciously do that for the bulls because they did capture it on the weekly time frame, as you can clearly see. So overall, weekly uptrend for TSM right now. Lower highs, right? Excuse me. Highs, higher lows, higher highs. Looking for a weekly pullback, and any pullback, tons of space, guys. Anything above 146, looking for a weekly higher low for possible further trend. If we come down into this support zone hard, I'll be looking to write some short puts below the market, preferably below 150 to keep farming premium on this fantastic company, which right now it's 10% higher. You could just add 10% to this. It's still under a 20 price to, forward price to earnings, around a 1.1 peg with a pretty decent free cash flow yield. One of my favorite semiconductors in the entire market for sure, and their demand and guidance is still excessively strong. So I wouldn't mind adding some long-term shares to my long-term portfolios. I did do a lot of it back there, right? I do it every month pretty much. So I got some here, some there, who knows, some here, right? I'll be a big fan of adding if they do come down there as well for the long term, but also some swing trades. Get a second look from me if we do come back down there into our support range, looking for those weekly higher lows. And that is everything for our market recaps. Hopefully you guys enjoyed that. Now let's look through the portfolio quickly to get a sense of what I did today and what I have for the week. Okay, so for the portfolio, guys, overall, I am anticipating a little bit of a pullback in the markets, and as such, I didn't really go too heavy overall over the course of the day today. We've made some phenomenal profits overall in the last few weeks in terms of our trades, in terms of the bear market wheel strategy. You can see that I traded a ton over the past roughly 3-4 weeks at this point in time, but now, after such a phenomenal rally, we're looking for a bit of a pullback, so I'm being a bit more cautious in my positioning. That being said, we have a ton of buying power for this week, and I am playing some earnings here and there. You can see I still have my Apple contract open, the 187.5s, which I opened on Friday. That one is still open and down ever so slightly. We still have all the things, but I covered all these in depth on the Friday session. So for today, I'll only be covering the ones with the blue dot, which are the new ones. AAPL, I went with this one early in the morning. They were down. I went with an earnings play. This is not the correct price at the end of the day. It's roughly around 25 cents right now. We're already up profitably. This is over, guys. I mean, this is such a wide move on AAPL, and if I get filled down there, I don't know what's going to happen, but the stock right now is $300, right? I have a short put for earnings down there at 165. which is crazy, right? 45% away. Granted, the expected move is 18%, but still, it's a very wide margin of safety. I would not mind winding this one down if I can close it for 75% profit before their earnings, but I figured I should nibble a bit. CALH, same concept, earnings play for tomorrow, 26.5 puts. If you guys don't know how I do my earnings trades, it's very simple. I go with 2 to 3 times the expected move of earnings, and I try to line them up with a support level. So all of my trades will be into a very large area of support. If they're not, and if they're not 2 to 3 times away, I won't take them. That's how I trade earnings. I never advise anybody follow me on earnings. They're all lottery plays at the end of the day, but that's what I'm kind of doing with my capital. Now, today we also open 2 different HIMS trades for earnings as well, 26.5s and 24s. Those should probably be all but worthless over the coming day tomorrow. Hood, this is a normal, not earnings play, but we opened it at the depths of the morning when Hood was down about 4%. We got the 39.5 short puts for Friday for about 14 cents. Bear market wheel strategy, those are 50% profitable already. In terms of other things we open, on ON Semiconductor, 33.5 put, we got it for 10 cents. That's where it's still trading. It was down 8% after earnings. We're all the way down there at 33.50. Bear market strategy into support at a very wide distance away. That would be another 13% drop by the Friday session. Should be safe on those, but we'll see. Palantir, I went for an earnings trade, 85 short puts for only 20 cents. Very far away, guys, on Palantir for those, but got a decent amount of premium, 0.25%, the bear market strategy, and respecting my earnings rules. You could argue, yeah, but you could have played them a whole lot closer. You got to be careful with earnings, guys, sometimes. The few times that you'll play them closer, you may end up disappointed, you may end up assigned, you may end up with a very heavy loss. I know sometimes the premium appears to be juicy and you can get seduced by it, but I am one to respect my rules. So although we didn't make a ton of money on these earnings, at least it's another position that we can add to these tallies, right? And every single one of these trades, they definitely add up over time when you're respecting your rules. Rocket Mortgage, we went with one of them. It was down 5% today. I like Rocket Mortgage. Now, these 11 puts, they have earnings on Thursday. This is an exception that I made for myself. They're down about 5.5. 11 is like 1 standard deviation away, but I want this stock. I've talked about it many times on the channel. I think it's a proxy play for bonds overall, as its mortgage, its main line of business is mortgages, right? If I get assigned at 11, I will gladly play the wheel strategy on this one. I would not mind, and I would not mind even going 200-300 shares deep at lower intervals as well. This is my first foray into this price. As you can see, I only did 1 contract for 15 cents. We'll see what happens. And I also rolled my SOFI calls. You may remember I had these SOFI 14 covered calls for the end of the week on these 200 shares that we've been pretty much having now for a while. And you can see after being assigned on SOFI, we've been in this one for a while, guys. But if I take a look at SOFI right here, my average cost on these SOFIs overall is now very, very low, guys. It's down to $11.70 per share. This was an earnings trade that I got. I mean, I played it very aggressively. $16. We got into this one prior to their last quarterly earnings in January. And from $16 with very good covered call management and averaging down on 100 shares, right? We have a cost basis now of 11.7. So I'm all into profit right now, looking not too bad overall, but we'll just farm the heck out of SOFI for the entire time that we can. Those are the only trades that I did. Nothing overly heavy for today, even though today was a red day. I didn't really put too much onto it. The only other thing I did is I opened up a bit of a hedge trade here. QQQ bear put debit spreads 480 to 475s for July. 2 contracts for about $1.76. They are slightly down, but if I'm looking for an index pullback into weekly consolidation, I have a ton of longs right now, right? So just hedging a tiny little bit to the downside. I don't have that much exposure because most of these contracts are just short puts, not really any big assignments anymore. So that's just a little bit of a hedge trade to the downside. That is the updates on the portfolio. As we move into the rest of the week, as we find more plays for either earnings or companies that drop after earnings or just overall market moves, I will be adding more and more positions, so I'll keep you guys updated throughout the week. So fairly light day for me as I am anticipating a bit more index pullback, and I'm being very patient as I did advise on the, well, not advise, as I said I would do in yesterday's top 5 options video. So that's everything for me today, guys. Hopefully you enjoyed the video. If you did, consider dropping a like. Would appreciate it for the growth of the channel. Also consider subscribing if you're new. We do these every Monday to Friday after the close. So hope to see you back soon. And lastly, if you have any questions, always feel free to leave them down below in the comment section, and I will gladly answer every one of your questions. I always love reading your guys' questions and comments overall. So make sure to, if you have anything you want to ask me, to ask it down below. And lastly, if you wanted to join a trading group, well, maybe you might consider joining our trading group. It's not only for trading, but it's also for education and long-term wealth creation through different methods, long-term portfolios, and trading in 2 different separate portfolios. You might consider joining ours, right? You get access to all of these trades overall, whether it's the wheel strategy trades, the earnings lottery plays that I do sometimes, the call debit spreads, the put debit spreads, the credit spreads, the leap call contracts that I do that you guys know me for as well, the share swing trades that I sometimes do as well, and the long-term portfolio building alerts as well. You get access to all those different styles of trades for everybody, right? Small accounts, medium accounts, large accounts. There is definitely something for everybody in there. You also have access to our private morning live streams every morning from the open for about 2-3 hours, where I trade and answer your questions live. And you can ask me everything you want on your stocks, your options, and your long-term portfolios in those sessions. If you can't be there, they're always recorded, or you can ask me all your questions in our chat rooms. I'm very fast to answer all throughout the day from like 9 in the morning to 9 o'clock at night. So that's another added feature. Private videos where I share strategies that I don't so much show on YouTube, small account, medium account, large account strategies, tons of different strategies, lessons on technical analysis, and other things. A lot of our members have been finding great value from those, and you get access to all my watch lists, all of them, and all my charts, especially the charts where I have technical analysis on them, and I do fundamental breakdowns. You get all that, just copy paste, 2 clicks of a button, and they are yours. So all that's included in the Discord. If you want more information, the link is down below in the video description. Hope to see you in there soon, and if not, I guess I'll see you back on the channel. That's it for me today, guys. The videos will be long through earnings, but I figure I should give you guys a lot more context than less. And then again, you guys can always skip through the videos with the timestamps in the description, right? That's it for me. Have a good day of trading tomorrow. I'll see you after the close. Take care and peace.